Mortgage interest rates fluctuate due to a variety of factors, primarily influenced by broader economic conditions. Here's a breakdown of the key drivers. Federal Reserve policies, or the Fed's actions, play a crucial role in setting short-term interest rates through its monetary policy. When the Fed raises or lowers its federal funds rate, which is the interest rate at which banks lend to each other overnight, it directly affects borrowing costs throughout the economy, including mortgage rates. Rising rates by the Fed typically lead to higher mortgage rates, as borrowing money becomes more expensive for banks, which they then pass on to consumers. Conversely, when the Fed cuts rates, mortgage rates tend to decrease, encouraging borrowing and spending. Inflation erodes the purchasing power of money over time, and investors demand higher returns to compensate for the loss in value. Mortgage rates often rise when inflation is high, as lenders want to ensure their returns outpace the rising costs of goods and services. Conversely, if inflation is under control or falling, mortgage rates may decrease, making borrowing more affordable. Economic growth is another key factor. In times of strong economic growth, there is often an increase in demand for loans and credit, which can push mortgage rates higher. A thriving economy may lead to higher inflation and rising interest rates as central banks try to prevent overheating. On the other hand, during an economic slowdown or recession, demand for credit may fall, leading to lower mortgage rates. Central banks may also lower interest rates to stimulate the economy. Mortgage rates are closely tied to the yield on 10-year U.S. Treasury bonds, which are seen as a benchmark for the broader bond market. When Treasury yields rise, mortgage rates often follow because investors require higher returns to compensate for the risk of lending over a long period. Conversely, when Treasury yields fall, such as during times of economic uncertainty or recession, mortgage rates tend to decrease as well. The supply and demand dynamics of the housing market can also influence mortgage rates. If there's a high demand for homes or limited housing supply, this can drive up home prices, which may lead to higher mortgage rates as lenders account for the increased risk of lending in a hot market. Conversely, a slowdown in the housing market could cause mortgage rates to fall in order to encourage borrowing and stimulate the market. Events such as political instability, geopolitical tensions, or economic crises can lead to uncertainty in financial markets. In these times, investors may seek the safety of government bonds, driving down yields and, in turn, pushing mortgage rates lower. For example, during the COVID-19 pandemic or the 2008 financial crisis, mortgage rates fell as investors flocked to safer assets, and central banks cut interest rates. The degree of competition among lenders also impacts mortgage rates. When lenders compete more aggressively for business, they may lower their rates to attract borrowers. On the other hand, if lenders are less competitive or if there's a tightening of credit, mortgage rates can rise. Mortgage rates are also influenced by individual credit risk. Borrowers with higher credit scores are typically offered lower rates because they are considered less risky to lenders. If there's a general increase in perceived risk, for example, during a financial crisis, lenders may raise rates to offset potential defaults. Mortgage lenders often sell the loans they issue to investors in the secondary market, such as through mortgage-backed securities, MBS. The demand for these securities can impact interest rates. If demand for MBS is strong, lenders may lower rates, and if demand is weak, rates may increase to attract investors. Mortgage rates are affected by a complex mix of domestic and global economic conditions, central bank policies, inflation trends, and market forces. When the economy is strong, rates generally rise, and when the economy weakens, rates tend to fall. Ultimately, mortgage rates are a reflection of the overall health of the financial system and the broader economy.